to do that. So it, it doesn't create, sometimes people forget, and they have a daily life sounds, and so sometimes it can diminish the quality of what you hear. So I was expecting maybe our program manager, Miss Kyolin, to say something. She's here, but maybe she has nothing to add. So if not, then I will begin. My seminar. So we will use Zoom. So I prepared a few documents. So let me share with you those documents. So yeah. So this is the introduction. Okay, so welcome everyone to this course called Investment Decision and Basic Valuation. Okay, so maybe I can introduce myself first. So my name is Olivier Grezard, and so I've been teaching this course for 8 years now. So I began with the intake number 10. So it's been some years already that I teach this course. So I'm always very happy to do it. Except that I'm even more happy when I can come physically in Vietnam to visit you and to teach offline, in your presence. I'm very sad that it's not possible to do this year because of the COVID context. Just to give you an update about, so I'm from ESCP. Okay, so I've been working in ESCP for 8 years, and I did my PhD there as well in finance. And so now I live in Canada. I took a position in Montreal, Canada, beginning last January. And so the situation here in Canada is that it's forbidden. The university say it's forbidden for teachers to travel and for students to travel abroad for any reason for the moment. So I've been teaching online since last March, when the things began to get not so good here, a few 1 or 2 months after you guys. And I've been teaching online since, okay? So 100% online since March. And next winter, from January to May, I teach online to my Canadian students again, because the university doesn't want things to be different for the moment. So of course, we had to think about how we can get organized for this course with you guys. And we had to find a balance between trying to be patient, and so people can come physically to teach you, because this is what we want at the end, that you have the experience to meet the professors, and we can talk during the breaks and everything. Of course, it's good. And thank you, Lynn, for recording. So yes, you send me the record at the end of the session. I forgot. So we had to make a choice, and frankly we thought about it, and we said, okay, it's not going to get better for a few months. It's getting better, and you guys, you just arrived, and you need also to take some courses on a regular basis, so you do not have too much material at the same time. If you have too much material at the same time, it's going to be difficult for you. So we decided to keep this course online. Also because I think it's very important, this course, for you, because it's a course that deals with the fundamentals of corporate finance. So this course is very important for you, because you're going to use what we learned together in so many other courses afterwards. Okay, so what we learn together will be very useful for the rest of the MEBF. So that's why it was important to keep this course quite early in the program, so you can, get into these fundamentals, and so get ready for the rest. Okay, so this is why we decided to keep the seminar this way. There is The main difference, I think, so we have two main differences this year compared to last year, is that this year, usually the financial analysis course is done before my course, okay? And so for me, it's very useful because, of course, you guys, you students, you have already a first course when you do some financial analysis. So that means also that you discuss the financial statements, okay? So this is what I realized that like 2 weeks ago, that the course was not done before me. And so I said, wow, so I don't need you guys to know financial analysis. You will learn that later. It's not a problem, okay? It's not a problem that the course is afterwards this time. The only thing is that I need you guys to know at least what are the financial statements, okay? The balance sheet, the income statement, and the cash flow statement, okay? So this is why I shared with you, this is why I shared with you this document, which is a pre-reading, okay? And I also built a video quite quickly. So sorry if the quality is not optimum, but at least you have my, explanations. So just for you guys to know these documents, okay? This is important, you know what it is. So I've been saying that very clearly because, in my opinion, for a large majority of you, if you did some studies, if you've been a student in economics, in finance, in accounting and everything, I think it's okay. You know those documents already, and certainly a lot of you, they already use those documents in their job as well, okay? I was more worried about the students who are engineer profile or equivalent, who are usually very good students because they are very good in mathematics and they learn very fast, but they don't maybe have the previous knowledge in in accounting, and so they don't exactly know what those documents are. And for some of you also, it's been a long time that you didn't study, so you need some to refresh. So that's why I put that online, okay? And the PDF and my video, so you can better know what those documents are. And you can also go to the book that you have or that you will have very soon with Colleen and Tram, depending on your city. And this is a Berg de Marzo book. Okay, so this book is a book I will use, but it's also a book that a lot of other professors will use during the IDBV, because this is a book we use in Paris for a lot of courses that we have with our students in Paris. So the Berg de Marzo book is the book you can rely on during the seminar, and usually I will refer to the chapter you need to know. So I know that you are very busy, that you work, you have families, you have a very busy schedule. So I don't expect you to have the time to always read everything, okay? But my advice is that when you have something you don't understand or you need to know better, please go to the book and read the few pages. Like for example, here you have 10 pages that tells you the story about the financial statements. If there is one reading that I require, is this one, because this is the fundamentals you should have before coming to my class. For the rest, we will study together, okay? And so usually what I do in class is try to find a way to have some moments when we talk about the theory, which is already on Canvas, and which is inspired from the book Berg de Marzo. And also we have I always try to have some moments during the seminar when we can make some exercises together so you can train, okay? So this is what we do all the time. We have moments when I talk and you listen, maybe you ask questions, but you listen to me, and sometimes you will have time to try to do exercises on your side, and we will correct them together, okay? These exercises we do together, they are very good training for the exam, okay? So it's very important for you that you take the opportunity to do the exercises, because in my mind, you are professionals, so you work, this is now 7 p.m. for you guys. You already work during all day long. Okay, so it's an extra effort so that you want to, you have the ambition to have a master, so you work during nights and evenings and weekends. So I try to make the 3 hours together the most efficient for you. So we also do exercises during the class. Okay, so we can check if you have well understood. Okay, so that will be we will alternate theory and exercises. Okay, during the thing. Also, as you understood, I forgot to record the Zoom, because I know I said to Kyolin and to Tram, please remind me, because usually when I begin to teach, I am focused on my teaching. I forget to record. So Kyolin just began to record the session, and so this is what we do. Also, we will record the sessions, and we make the videos available on Canvas afterwards, so you can have a look again at the videos and everything if you need to know more. So that's one of the positive sides of online teaching, because I know that there is always one student. When I'm in Vietnam, there is always one student who records with a tape what I say. I always discover that after a few hours. And wow, I have to be careful what I say. And here it's for everyone. We will share for everyone the video session. So we will use Zoom, of course, you understood. Okay, so Zoom will be for the live sessions, and for the rest you will have Canvas. So Canvas will be the place where you can find all the documents, where you can find some announcements, some additional messages, and so on. So everything, the platform to communicate between us. Okay. Okay, so about the daily session, this is it. So, but this year I said a few things already. Okay. Yes, one thing also, the program manager Kyolin and Tram, they said to me, your students, so they are quite worried this year because it's online, so they're afraid. I mean, they want to be sure they understand everything. So we agreed on that. I will do something that I don't do normally. So that I will make a final exam from a previous year available on Canvas in a few days at the end of the seminar. So with the solution, so you can train. Okay, so you can see what the final exam looks like and how, so you can train with it, and so you can get even more ready. Okay, so the exam is planned for the 24th of January, I think. I said that somewhere in yeah, so 24th of January, because Tet holidays are early this year compared to the other years. So so this is what we do. Okay. So I will get to the syllabus to get more details. So you have my about the professor thing. I don't it's not very useful to read that. You can read it if you want. Okay, so let me explain to you now what we're gonna study together. So in this course, you can see you have 5 topics, okay, that we will study together. The time value of money, the interest rates, the valuation of bonds, the valuation of stocks, and fundamentals of capital budgeting. Okay, 5 things. These topics are about corporate finance. Okay, it's really about corporate finance. So when we talk about the time value of money, we will discuss, and this is today, we will discuss how we can try to find the value today of an asset, thinking about what are the cash flows we should receive in the future from this asset. Okay, so this is the essence of finance. The essence of finance compared to accounting is that in accounting, usually, even if it's less true now, but in the past, accounting is that you were using historical information, right, to build the financial statements at the end of the year. Okay, and so people can look at the financial statements, the balance sheet, the income statement, the cash flow statement. So they build an opinion on the situation of the company. Finance is more about looking at the future. Okay, we want to know what is the value today of something according to what we expect to receive from that thing in the future. Okay, so this is what we will study in the time value of money. And an example of this is the stock market, right? Usually when you have on the stock market somebody who gives an information, or like for the COVID-19, for example, or we're going to close all the businesses, you suddenly see all the stocks going down. Okay, why? Because we have this new information about what's going to happen in the future. And because all the business are closing down, of course, every business will earn less, right? And so will the market will interpret that as a loss of value of the stock today. Okay, so when information about what's going to happen in the future is disclosed, it's going to influence the value of the stock today, because the value of the stock today is nothing else than the value of what you expect to receive in the future. Okay, so this is really the essence of what we're going to study together during these 24 hours. The time value of money thing really is going to be about this. Then we will move to interest rates. So you have an idea, of course, of what the interest rates are, because we will need to use rates to be able to travel into time with the money. And then we will apply that to 3 different situations. How we can use what we learned to evaluate the value of one bond. Okay, I know that usually some of you guys work in the bond business, so usually they are very aware of this. Valuation of stocks, okay, so stocks on the stock market, okay, so shares of companies, and fundamentals of capital budgeting. This last part is, I think, my favorite, because I really like that. This part is about when a company wants to invest, let's say in a machine or in a project, how can we help this company to know if it's a good opportunity or not? And here, what we will do, and frankly, I'm really passionate about this topic, because what you really have to do here is to compare the price you should buy the machine today with what you expect to receive from the machine in the future. Okay, what are the cash flows that will be generated thanks to this machine? And you will bring back these future cash flows today to compare what you should pay and what you should receive from this project. And if it's positive, of course, you should go for it. So this is what we will do for the last part of the seminar. So if we have a look at the detailed planning, this is what we have. So we have a few sessions, and see Tuesday, Wednesday, we will talk about the capital budgeting. And this is also what will be used for your group work. Okay, so for the group work, we will talk about capital budgeting. So it means that we should have Friday to Tuesday to Wednesday, when we have a normal course with theory and everything. And the 2 last sessions of the seminar will be about group work. So Thursday will be about you guys are in groups and you prepare. And the last session will be about you guys presenting your project. Okay, so for this last session, we separated into the 2 cities, because we want to have not too many groups to present. So each group have more time to present. So we will have the Hanoi groups on Friday and the Ho Chi Minh City group on Saturday. Okay, so we have this moment. Okay, so this is how we get organized. So usually I have been doing this since the beginning, the group work. Why? Because I know that for you guys, 24 hours can be long to listen to me. Okay, sometimes at the beginning it's okay because it's new and you learn things, but after a few days, maybe it's good also to vary the pedagogy of the course. And so you have this moment when you work in groups, and then I can see with your presentation if you understood well. Okay, it's usually a fun moment as well when you have the presentations, because you want to defend your project. Of course, you present in English in front of your colleagues and everything. So it's quite, it's quite exciting, this moment. So I hope it's going to be the same thing this year, despite the fact that it's online. just to make a link with the evaluation. So this group work will count for 30%, okay, of your mark for this course, okay? So the group work will count for 30%, and the final exam, which is an individual exam, of course, will count for 70%. Okay, so the exam is usually 2 hours and 30 long. It can vary a little bit depending on the number of exercises, but usually now it's quite stabilized to this duration. Okay, so this is it for the introduction, I guess. I just check on my PowerPoint I prepared. Yeah, so I think it's this is it for, let's say, the presentation of the course. Do you have any question that you would like to ask me through the conversation, through the chat, or even putting your mic on? So if I don't have any reaction, it seems for me, I understand that it's okay for you. So my worry is that one of the favorite moments I have when I come to Vietnam is the breaks of the course, when usually we have dinner together, and so I can know you better, and we can discuss about your professional situations and everything. So unfortunately, this is something that it's not going to happen this year, and this is very sad. And for everyone, for you and for me, I think this is what we miss with the online experience. So we have to find a way to communicate. So do not hesitate to communicate through the chat if you have any question. When you work in groups, next Thursday, Friday, you will be in breakout rooms, project about. So hesitate. Even if you are 43 people, do not hesitate to ask questions on the chat, to react with me on the chat, to say, it's okay, you can move on, we understood. You can ask questions and everything. It's very important we keep some interaction, okay? So no, no chat for the moment, okay. So of course, we will have a break around the half of the course, huh? So you can have dinner. Okay, so I think, yeah, one day, one topic. Maybe it's not going to be so clear. Huh? Maybe we can take more time for one topic, because usually we have sessions of 4 hours long. So this time is 3 hours long. So for example, time value of money, usually it takes me 4 hours to do it. If what we do the schedule totally, don't worry, we will have the time to finish everything, okay? And sometimes it's good to take the time to do some exercises. Okay, so now if you, and it's in the, which is the part number 1, which is called time value of money, okay? So this is the first chapter. Here you can see that you have the references to the chapter of the book. Okay, so these chapters are the chapter in your main book, which are related to the topic. If some of you guys would like to go into the book to read, I invite you maybe to focus more on chapter 4. Chapter 3, I talk about it very chapter 4. Okay, so if you need to read one, chapter 4. Okay, so let's begin with the time value of money. So again, the time value of money, the definition is how we can travel into time with money. Okay, so I need you also to have, because for the exam, it's going to be on the table, right? So you will do calculations on the paper with a calculator and everything. So get ready to have your calculator with you now, a paper and a pen, okay? Because we will do some exercises. So you need to train with your paper, because this is what you're gonna have for the exam as well. Back to my topic, time value of money. So it's how we travel into time with money, okay? And the first thing we must agree on is an economic theory, which is about what we call the valuation principle. So what is it? Well, the first thing is how the method we use to value an asset. Maybe you know that you have different methods to value the asset. For example, in accounting, we're going to have the historical value, for example. Okay, you can have the liquidation value. Well, you have a lot of different values that you can take into account to evaluate something. Here in our course, we will focus on what we call the market price. Okay, so the market price is globally should be, to make it simple, it should be quite big to buy this asset. Okay, and so we imagine that for our calculations, everybody will take the same value, which is the market price. Okay, and so then what we will do is to compare the cost and the benefit of the decision. Okay, as I said earlier in the last part of the seminar, when we talk about capital budgeting, we will compare the price we pay today for the investment and the cash flows we should receive from that. We receive from that investment are higher than the cost. Of course, it's a good decision for the firm. Okay, and so it creates mass corporate finance people is to build financial information so we can give that to our manager, so our manager can take a decision. Okay, this is our job. Okay, maybe our manager is not a finance person, but maybe he got, he knows things, he knows the market, he has a lot of experience, or she has a lot of experience, and so on. Okay, so they know all the factors than the financial factors. Okay, they know that if the investors enhance your reputation and so on and so on. But they need financials to be able also to see if it's a good decision on a financial point of view. Does it create value? Okay, so this is what we will do here. And so when the value of the benefits exceeds the value of the cost, of course, this is a good decision to take for the company. And this is our job, is to help the company with the financial, to provide the financial aspects so they can take a decision. Okay. Another thing, another theoretical point before we get into more practical point. We also gonna consider that the law of one price applies. What does it mean, this law? It means that everybody at the same time gives the same value to an asset. Okay. Okay, so we must admit that we are in a perfect market where everybody, every financial analyst and everything have the same estimation of the cash flows that you should receive from an asset. Okay, and so that the value of the cash flow is, the value of the asset is the same for everyone. This is, for example, what you have on the stock market, right? When you have a stock market which is organized, the value of the stocks will fluctuate according to supply and demand, the fact that people buy and sell, and the fact that people buy and sell, it's because they correct this one price thing, and so the one price evolves, and the price of the stock on the market reflects this one price that people are thinking the asset is worth. If it's not the case, if there is not a law of one price, okay, so it means that you could have what we call an arbitrage opportunity. The arbitrage opportunity is that it's something that we will not use, but it's just for you, for me to give you an example. it's like you can buy one asset at a low price, and you can sell it in a different place at a higher price, okay, immediately. So it means that, and this is not what we want in finance, we do not want that we can make a profit taking any risk, right? Because if you buy the asset 10 somewhere and you can sell it immediately 11 somewhere else, you can win one, okay, you can earn one, but you did not take any risk, okay? So we will consider that this situation does not exist because we are on organized markets, okay? And so every asset has one price only, okay? Why? Because of course, the theory in finance says that if you sell with a higher price, it means that you are taking a risk, and the risk is reflected in the interest rate. Okay, so this is what we do. So we will consider there is only one price for things. Okay, so that's for the first part, the chapter 3. Do you have any question in the chat or anything to ask me? Still no question? Okay. Okay, so let's move to the time value of money then. Okay, so the time value of money is when we want to travel into time with money. Okay, so that's a very important chapter because this third chapter also will be used for the next ones together, and also for the rest of the MEBF. So what we want to do in this chapter is to work on, calculating the present value of an asset. Okay. So in terms of vocabulary about present value, and when we talk about the asset in the future, it's the future value. Okay. And when we go from the present to the future, we say we capitalize. Okay. And on the contrary, when we go from the future value to the present value, we say we discount. Okay. This last scenario, when we discount, is usually the scenario we will have, okay? Because we usually imagine what could be the cash flows in the future, and then how can we calculate the present value of those cash flows? It's usually what's gonna be interesting for us. Why? Well, usually we say it's because the date 0, the present moment, the date 0, it's the moment when we take the decision, okay? So this is usually when we want to have some. So let's take an example to illustrate this. So we have here an example this is from your book, and we have 3 situations. So we have a capital of $1,000, okay, that we save during 20 years, okay, 10%. So we have the first part, which is the red part, which is the amount remain the same. And here we have 2 types of interest. Okay, we have the green ones and the, I don't know, blue one, let's say. So how do we call that? So this is my first interaction with you. So I need answers in the chat. It's finished now for you to hide behind your cameras. I need some answer in the chat. How we call that green interest and the blue interest? How do we call them? And how we calculate them? So I need some answers in the chat right now. How do we call that? Somebody would like to tell me? Interest of deposit. Yes, that's true. And is there a specific name for it? Because I think the blue is also the interest. Oh, I don't know what you mean by interest of deposit, but that's true that this is the interest that we have. Yes, that's it. It's on the principal amount. Okay, so this is what we call. Thank you for being the brave person, the first brave person to interact on the chat. You are my savior. You are my hero. I'm not alone in the room. Thank you. Thank you very much. Yes, so this is what we call also simple interest, right? So what your coding was saying, that is the interest what we calculate on the principal amount, okay? So the way it's been calculated, and yes, blue is a compound interest. So that's it. So we have simple interest and compound interest. So we have the two situations, okay? So to calculate the first, so we have the capital. So let me put that in the chat. So it's no, maybe maybe I can use Excel here. So I'm gonna, if you give me 1 second, I'm gonna open one Excel sheet and share it with you. Okay, so you should see the Excel file now. So the capital is, let me increase a little bit. Okay, so we get the capital. Okay, so capital is 1,000. So then we get the simple interest, okay, as you said. And so the simple interest is actually 1,000, right, times the rate. I think it's 10% times the number of years, 20. Okay, so sorry, there is one extra zero, so it should be okay now. Yeah. So we were saying the simple interest, so it's interest on the capital, interest on the amount we put in the deposit. Okay, so the amount will be each year the same, right? And so we have interest on interest, okay, of the assets going to be 1,000, okay, times 1.1, okay, exponent 20, okay, and so sorry, let's do it this way. Yeah, so the future value. And so the interest on interest would be the difference, right? Interest on interest, this and the rest, okay? So the future value of this, okay, it's gonna, so the view of what you have on your bank account after 20 years in this situation, okay, and how we can understand this. It's a part of your capital, so that's the red, okay. It's the simple interest, so that was the green, and the interest on interest, which is what I call the blue, because I'm not very good in color. I'm not colorblind, but sometimes I don't know how it works with colors. Okay, so this is what we have. Okay, come back to the PDF document. Okay, so here you can see that the cumulated value of the 20 years, it's nearly 7,000. So we just calculated it, 6,727. Okay, and so we calculated by doing so 1,000 times 1.1 exponent 20. Okay, so this is how we did it. Okay, so for the moment it's quite simple. So what we want to show with this graph is that the comp, as one of your colleagues was saying, compound interest, okay, is the fact that we earn interest on interest. Okay, so there is a sort of an exponential situation here. Okay, I don't know if you see my little cross, I hope so. That I try to point on the graph. Is there somebody who can say to me, you see this little cross that I move? when okay, cool. Okay, so I can show on the, that's very nice. So yeah, you can see the exponential thing here. Okay, so interest and interest. Okay, so this situation of a compound interest that we find here will be our main scenario. Okay, future value will be okay, c'est pas grave. Future value will be equal to the present value times 1 plus the rate exponent the number of years. Okay, so that's how we calculate the future value out of the present value. So this is exactly what you have in the chat, right? 1000 times 1.1 exponent 20. Okay, and of course, on the contrary, you can go the other way around, where you have this, the other way around. When 20 samples are simple, don't worry, we couldn't do exercises to check a little bit more complicated things, but for the moment I want to just show you, what is important. So the fact that we will use compound interest situation, of course, and the fact that we can travel into time with money using 1 plus r exponent t. Okay, so that's very, very important. That's very important. And we need a rate into time with money. Of course, we need the number of years, but we can imagine that the number of years is something that we know. This is the rate. Okay, so the rate will depend on the situation. It's going to depend on the situation. So during the time value of money chapter that we discussed today, we're not going to talk about the rate, but this is why in the syllabus you have the second part, which is about interest rates, because this is when we're going to think about what could be the interest rate we have to take into account for one specific context. Okay, so the rate, how is it's one. So you have, okay, 1.1 calculated. So this is here, right? So it's 1 plus 10%, which is the rate. Okay, so this is 1 plus 0.1. So this is 1.1. This is how it's calculated. It's using this. Okay, so it depends on the rate. Yeah, you're welcome. So it depends on the rate. Okay, and so what I was saying is that, yeah, the rate will be different. Okay, if you save money in your bank account, you know that the deposit rate will be low, right? And then if you invest in a very risky project, it's going to be higher, right? So it means that R will be different with the context. And one of the things that will change is the level of risk of what you are doing, of course. So the rate must reflect the risk you are talking about, okay? Which is exactly what was said here when we're saying that we cannot take arbitrage into account, because it would mean that we make profit without risk. We cannot accept this because the risk is reflected in our rate. Okay, so that's the first thing. I think I have a quick example here. Okay, we have the answer already. So let me share my PowerPoint document instead, so we don't see directly the. Okay, so you should see my PowerPoint now instead of my PDF. Yes. Okay, so we have a first example here. Example, you are saving for a new computer and you need $2,000 to buy a new computer in 1 year. Okay, so how much do you need to set aside now? And knowing that you can earn interest at 3% per year. Okay, so I'll let you 2 minutes to check if you're okay to do that on your calculator, and you can share your solution on the chat when you're done. Do you have it? If somebody can check, can share with me we saw the answer from your screen. Oh, really? Like now or okay? Actually, we are seeing the answer. Really? Okay. Okay, so must be some problem with because I did. Okay, so it's strange. So okay, so we have. I'm gonna try to find another solution to do it. So we so let me go back to the PDF. I know how I'm going to solve this problem. I'm not going to use my PowerPoint. Okay, so you have the solution on the board. Okay, so you have 2000. Okay, so when we want to calculate the present value of it, we just use a formula we used before. So 2000 divided by 1 plus r exponent 1, right? And so we have then the answer, which is 1942. Sorry, I lost the chat document now. Sorry for that. So I come back to the screen. Okay. Okay, should be okay now. So what does it mean? It means a few things already. It means that, yes, what is important for me to tell you here is that this is the same thing. This is the same thing to have in your pocket 1,942 today than to have 2,000 in 1 year. Okay, because if you have 1,942 today, you can go to the bank and save that at 3%. So you will have 2,000 in 1 year. Okay, another way to put it is that if you need to have 2,000 in 1 year, you need to see. Okay, so I can see your full screen, Professor. Okay, so let me check this again. Can you see my PDF document now? Okay. Okay, sorry for that. Sorry for that. Yes, thank you for telling me, because sometimes I don't see. So again, it's the same thing to have 1,942 today than to have 2,000 in 1 year. Or if you want to have 2,000 in 1 year, you need to save 1,942 today at 3% to be able to have this amount. Okay, so again, here we are traveling into time with money, right? So it's the same thing. So we have to understand, and so it's very important for you to remember that if you want to compare date, okay, because sometimes you forget that before adding, subtracting cash flows, they need firstly to be at the same date. Okay, it's see, because here we have 1,942 today, 2,001 year. Okay. So if we want to make 2,000 that to compare cash flows, they have to be calculated at the same date. You cannot add, you cannot subtract cash flows which are not at the same date. Okay, it's not possible. Okay, so our travel into time with money is that we calculate the cash flows at the same moment in time. So the moment we are talking about will differ, but usually this is the date 0. So we will, in a very vast majority of situation, we will calculate the present value of something. But sometimes it's not the case. So we have to stay open-minded. Okay. So now let's talk about what is very important for you too. So this is the first time we talk about, but don't worry, we talk about it during the week a lot. NPV is the net present value. So usually when you have the adjective net, it means that you subtract something from something. Maybe you see in financial analysis, you will talk about net debt, you will talk about net financial expenses and so on. So when you have net, you have to remember when you see net, it means that you subtracted something, okay? So here we can see, yes, we subtract something. We have the minus sign here, right? So yes, we subtract. But what do we subtract? What do we subtract? So we compare the investments of a project, okay, with the cash flow of the project. So the net present value of a project will be to compare the present value of all the future cash flows you expect to receive in the future, which are CT that will happen during several years, to the investment you make for the project today. Okay, so this is a situation I was talking about earlier for you. You are in this situation where your company wants to buy a machine, and so the price that the price the company will have to pay today is high, okay? And on the other side, the company will receive some cash flows in the future thanks to this machine. These are the CT, okay? And so what we want to be able to compare is the present value of CT in the future, all the cash flows you expect to receive from this machine, with the price you pay for the machine. Okay, so this is exactly how we can apply our model and how it can be important for us as finance people, and how we can help our company, okay, if we work in a corporation. So, of course, if the present value of the future cash flows, this number here, is higher than investments, it means that the benefits of the project are higher than the cost of the project. So it creates value for the company. So we should undertake this project. On the contrary, if the cash flows we expect to receive from an investment are lower than the investment, it means that we pay a higher price today compared to the benefit we will receive, calculated in present value today. So it means that it's not a good opportunity for us. So the NPV is a very interesting tool for this, because it helps us to take the decision. And certainly you will calculate the NPV in the group work project later on during the week, even if the cash flows will be a little bit more sophisticated than that. So the NPV will be really the difference between the cost of the benefits and the project. So if the NPV is positive, it means that the benefits of the project are higher than the cost of the project. So it means that the project creates value. On the contrary, if the NPV is negative, it is higher than the present value of the benefits of the project, okay? So the project destroy value for the firm, so we should not undertake this project, okay? So you have a message from Miss Curlin about the names, right? So you check. And so last situation, if the NPV is equal to 0, so it means that the price you pay is exactly equal to the benefit you receive. So on a financial point of view, it's indifferent, okay? It does not create value. It does not destroy value, okay? So on a financial point of view, there's no decision we can take. But then you can maybe think about the other aspects. Maybe the project will create new jobs. Maybe the project will be a green project, which is good for the environment. Maybe it's going to be so good for the reputation of the firm. Maybe you're going to settle this project in a geographical area which is far from Hanoi and Ho Chi Minh City, so it's going to develop some activity in the regions and so on and so on. So you have maybe non-financial aspects that's going to be positive, and so you have maybe to take that into account as well. Okay, so this is it for the net present value. Okay, so let's move on. IDBV. D'accord, tac, tac. Okay, so let me open this. Because I want to open a file where you don't have the solution. Okay, so that's for the net present value. We discussed already about the cost of capital. We said that the rate we will take will be different from one situation to the other. Okay, so we need always to consider what we call the opportunity cost of capital. Okay, which represents actually the rate which should be applied in our situation. Okay, so it depends, but usually I think the best definition, the one I prefer this one, it's the when you want to choose the rate that you should apply to one project. For example, if you want to, like the next example to come, you want to decide if it's a good opportunity for you to invest in a construction project. Okay, so there is this a new construction project around your city, and maybe you would like to invest in this project, but you don't know if you can do it. And what is the rate you should use to discount the cash flows, right? Well, in that case, you cannot find a rate like for a stock market or something like this that the rate can be found somewhere and it's public. You have to find it in a different way. So in that case, usually you will try to find a similar project that has been done by your company in the past or by a competitor in the same geographical area. So you can find the proper discount rate to apply to your project. And so this approach is what we call the opportunity cost of capital. It's the expected return of best available marketed investment opportunity with the same risk and same term meaning the same number of years. Okay, you need to find a twin project, so you can use the rate. So this is how you can find the rate if you cannot find it. You will study with my colleagues, and maybe some of you guys, you studied that in the past already. You have some financial models that exist to calculate the rate, the average cost of capital, okay, the CAPM, capital asset pricing model. So this rate, how to build the rate when you don't have this direct information, is also something you will study again in next courses to come with my colleague Pramwan Bunkanawisha, who's going to teach you the financial structure and strategies, and other teachers, also other professors. So the cost of capital is something, of course, that you will discuss again in the future. So here we are, the first course in corporate finance. So again, we are learning together the fundamentals. So please know that you will rediscuss the cost of capital later. So let's take an example. Okay, let's take an example. So hopefully you don't see the solution, this one, because I'm back to my PDF version. So maybe I will try to avoid to use my PowerPoint, because obviously I showed the solution too soon. So it's not fun for no one. So here we have an example. It's a very simple example. I would like you, so you have an example, okay. You have a building. You have a construction project, and somebody comes to you and say, okay, if you invest 350 today, you can sell this 400 in 1 year. Okay, so this is the first opportunity that you have. Okay, and you say to yourself, okay, so yes, this first person comes to me and he says that I have to give him 350 today, and he will give to me 400 in 1 year. Okay, so that's the first approach. And then you say, is it a good opportunity for me? I don't know yet, because 350, this is today. 400, this is in 1 year. So it's not at the same moment in time. So of course I cannot compare. So I need to make the 400 travel into time back to the date 0. And then you here you say, okay, 350, 400. Okay, so so I miss one information to be able to calculate the present value of the 400. I need a discount rate, okay? And in this context, it's not interest rate we're gonna take. We're gonna take the rate of a opportunity, other opportunity that you have, okay? And somebody comes to you and say, okay, usually for that kind of project, it earns 7%. Then you have the information, okay? You say that on one hand, you can go somewhere else and earn 7%. And on the other hand, you can stick here and spending 250 today and earn 400 in 1 year. So what you're going to do is say, okay, I'm going to use this 7%. And if with this 7%, I discount my cash flows and I calculate the NPV and it's positive, it means that the rate of return of this project is higher than 7%. And so I can undertake the project. Okay, so this is the theory behind. So I would like you guys now to calculate the NPV of the, sorry, not NOV, NPV. What is the NPV of this project? Okay. And secondly, what is the rate of return of this project? So I'll let you 2 or 3 minutes to do this. Yes, so I begin to see some correct answers. So let me give another maybe 1 minute more for the other colleagues. Maybe you would like to try to finish, and then I show the solution. That's correct. That's correct. So we have a lot of correct answers. We have a lot of correct answers. So let's have a look together on the official solution. Just for you guys to know, you can see that I have slides that you don't have on my PowerPoint or on my PDF with the solution. So usually what I do is that at the end of the seminar, I send to the program managers, Kyolin and Cham, the missing slides, okay, with the solution, so you can have them afterwards. I usually I don't give them right away because I want you I want you to try to do it by yourself first, right? I think it's more exciting for everyone. So this is a solution. So thanks a lot for the all the students who answered to Hien, Tui, and Huyen. Maybe my pronunciation is not good. My here, Kien, Huyen, Ha, Chang, So maybe, sorry if I mispronounce the name, but at least I try. You know, it's not easy for us French guys to pronounce properly Vietnamese. And so we have the solution here. So yes, you understood that we have an NPV of which you are even more precise than me. You find 23.83. I rounded to 24, but you are right to keep it 23.83, and the rate is 14.29. You have 14.29. So just to recap for the rate, I think I calculated that somewhere on an Excel file. So let me share with you guys. Yeah, it's not very detailed. So it's 400 divided by 350 minus 1, that is equal to 14.29. So this is correct what you found. So what does it mean? It means that the NPV, so the NPV is, as you said, 374, and the rate of return of this project is 14.29. Okay, so we have two information here which are very important. The first is that we know how to calculate an NPV, okay, and then we know how to calculate the rate of return of one project. So in this project, if we come back to the PDF document, we know that the NPV of the project is positive, 24, sorry. So it means that it's a good project for us, okay? Investing 350 today to receive 400 in 1 year, it's a good thing if we want to earn 7% on a project, because we earn even more. Because when we use 7% as a discount rate, we have a positive NPV of 24. Okay, so it means that the project creates value for us, right? And when we know that it creates value, we said, okay, so it's more than 7%, the rate, right? So what is a rate? And so you calculated the rate is 14.29 for Kien. So we have a return which is higher than 7%. And this thing is called the internal rate of return. Okay, so it's also said IRR. Okay, so we have NPV and IRR, which are two very important topics to discuss. Okay, and so we will focus on these ones later on during the week. So keep in mind that these two ones are very important. If you know them already, good for you. If you don't, well, these are very, very, very important and fundamental tools to take a decision in the context of the project. The NPV, the 24 in our case, represent the value which is created. We create a value of 24 euros, dollars, Vietnamese dongs, whatever. And so this is a NPV. It's something which is said in the currency, right? In euros, for example. The internal rate of return, 14%. It's a rate. Okay, so it's the two expressions of the same thing. One is in value, the other is in a rate. So that's good because it gives a better idea of the project, right? Because if you have a project of different size, maybe it's better to look at the internal rate of return, right? Because of course the value will be higher in a bigger project, but doesn't mean that the project is better in terms of rate of return. So it's good to have both, but usually what we say is that the most important one is the NPV, okay? The NPV is the most important. Okay, so now let's move on with some calculations. So here we have seen that we discussed a project which is about one period only, but of course you can have several periods, right? So So we have this formula that we can use. Okay, so the present value will be finally the present value of all the cash flows we expect to receive, discounted at a rate, and we have 1 plus r, then 1 plus r square, and so on. Okay, so example, let's take this example. Assume that the average college tuition costs $20,000 per year that you pay at the end of the year. For a Frenchman just start college, what is the present value of the cost of a 4-year degree when the interest rate is 10%? Okay, so I'll let you try to do this by applying this formula, right? So we have 20,000, 4 years at a rate of 10%. Okay, so I'll let you a few seconds to do it, and you can share the solution with me when you find. Yes, that's correct, Hien. And that's correct, Ha, as well. So again, I let 1 more minute for your other colleagues or for some other colleagues to. Yes, here it's correct as well. 63,000 something. And on my side, I have the solution on the PDF, but I was trying to redo it on Excel to show you something. You know, you really need to train with calculator, because I can show you on Excel, but the day of the exam, you will have to use a calculator. So you really need to get used to it. But I try to show it in a different way. 1 more minute for your colleagues to finish, and then I show the solution. As you can see, the light in my room is not very good. It's because it was 7 in the morning when we began, so it's still the night here. So now the sun is coming up, but it's not a great light because it's a gray sky, and in Montreal, you know, winter can be sometimes cold. Yes, so I think so just for you to know, as Kong is showing the calculation with the NPV, you will not be able to do that for the exam, right? You will have to use your calculator. So you need to know how to do it with a calculator, but that's true that the formula is